Imagine it is December 2001. You are 43 years old. You are a careful woman named Maria living in Buenos Aires. You have a respectable apartment in a pleasant neighborhood. You have a good car that you bought on credit, because that is what stable middle-class people do. You have a university degree that was supposed to guarantee your place in the professional class. You have a life insurance policy that has been paid into faithfully for years. You have a small vacation property outside Mendoza that you and your husband bought because property everybody said was the smartest thing a serious family could own. You have a home full of respectable things, furniture, electronics, clothes, a home theater system bought on installments, the ordinary evidence of progress. Then the government freezes the banks. You cannot access your money the way you thought you could. Within days, the peg breaks. Within weeks, the currency loses most of its value. The stores still exist, but prices move like living things. The police are in the streets, retirees are banging pots outside government buildings, and you stand in your apartment surrounded by everything you were told represented stability and realize slowly and then all at once that most of it has become functionally worthless, not destroyed, not stolen. Worse than that, useless. That is the word I want you to sit with, because people have a cinematic picture of economic collapse. They imagine flames, they imagine empty roads, they imagine the end of civilization. Sometimes collapse does look theatrical. More often it looks administrative, bureaucratic, technical. The government office is still there, the bank logo is still on the door, your house is still standing, the car still starts, your degree still hangs on the wall, the insurance policy still exists. The retirement account still has a number on paper, but the relationship between money and reality has broken. And when that relationship breaks, the purchases people were most encouraged to make are often the very purchases that trap them. I am not talking about this as a man who hates homes, hates education, hates saving, or hates responsible behavior. I have spent my life praising prudence, discipline, patience, and clear thinking. But clear thinking requires a willingness to say what many people do not want to hear. A purchase can be perfectly rational inside a functioning system and still become a terrible burden when the system itself fails. That is the lesson the middle class learns too late in every major financial breakdown. The rich usually survive because their assets were never fully trapped inside one national system, one currency, one payment rail, one labor market, one promise structure. The poor survive because they had so little formal wealth to begin with that the collapse cannot destroy what was never fully there. But the middle class is integrated. That is the danger. Its wealth is in the mortgage. Its mobility is in the finance car. Its future is in the pension. Its identity is in the degree. Its comfort is in the lifestyle goods bought on the assumption that income, credit, and stable money will continue. Every thread runs through the same system when that system breaks. All the threads snap at once. That is why I want to walk through 5 purchases that economic collapse has rendered useless again and again across countries, decades, ideologies, and currencies, not as theory, as autopsy. I am going to stay with Maria as a guide because she is not reckless. She is not foolish. She is not a caricature of greed. She is the most dangerous kind of victim in a collapse, the responsible one, the obedient one, the one who followed the rules. And that is precisely why collapse is so cruel. It does not only punish vice, it punishes misplaced trust in systems that look stable long enough for the trust to feel reasonable. The first purchase that so often becomes useless is real estate bought at the wrong point in the cycle. Nothing is more deeply planted in the modern middle-class mind than the belief that property is safety. They are not making more land. Your house is your greatest asset. Real estate always goes up over time. These phrases are repeated so often that people stop hearing them as opinions and start hearing them as natural law. They are not natural law, they are cycle-dependent beliefs. Now, do not misunderstand me. A home can be a wonderful thing. It can provide shelter, continuity, memory, and dignity. It can also be a magnificent financial trap when bought into a market inflated by cheap credit, cultural mythology, and a shared refusal to imagine reversal. Look at Japan after 1991. For a decade, real estate prices had been treated almost like divine revelation. Families took on debts of absurd length because they believed the values would keep rising. The system encouraged them. The culture blessed them. The lenders facilitated them. Then the cycle turned. Prices collapsed and in many places kept collapsing or stagnating for decades. What had been sold as a ladder upward became a weight around the ankle. Families could not sell without realizing enormous losses. They could not easily move. They could not rent at enough to cover what they owed. What had been called their greatest asset became a prison. Look at the United States after 2008. Millions of people bought homes under the assumption that appreciation was almost a feature of citizenship. The mortgage structures got looser because rising prices made everyone feel wise. Then prices fell. In many markets, they fell hard. The part people remember is the price drop. The more important part is what price drops do to behavior. People stop buying, credit tightens, sales freeze, liquidity disappears. The house remains physically there, but as a financial asset, it becomes something else entirely. You cannot extract value from it. When you most need value, it becomes illiquid at the precise moment you need liquidity. That is what kills people financially. In Greece, after the sovereign crisis began, homes did not become rubble. They became frozen assets. The market did not simply crash in a clean downward line. It seized, owners could not sell. Buyers vanished. Meanwhile, governments desperate for revenue turned toward property taxes. So the owner was left with the worst combination imaginable, a supposedly valuable asset that could not be converted to cash and still produced ongoing obligations. That is how collapse makes real estate useless. Not because bricks stop being bricks, because the financial architecture that turns property into accessible wealth breaks. Maria's vacation place outside Mendoza did not burn down. It simply lost the thing that made it feel like an asset. Buyers, liquidity, confidence, affordability. It became a cost center in a world where her family needed flexibility. That is the key distinction. In stable times, people confuse value with appraised value. In collapse, only usable value matters. Shelter you live in may still matter deeply, but real estate purchased as an investment at the wrong stage of a cycle can become the deadest kind of wealth. It can sit there expensive to maintain, impossible to sell, and emotionally painful, because the owner keeps remembering what it was supposed to mean. That is what I want you to understand. A building can stay physically intact while its financial meaning dies. The second purchase that becomes useless is the new automobile bought on credit. This one is even more revealing because a car feels so ordinary, so practical. So beyond ideology, a house carries mythology, a car carries routine. You need to get to work. You need to move children. You need to live. So the purchase feels modest and sensible, and inside a stable system, it often is. But a car is not a self-contained asset. That is what people never think through. A car depends on fuel, it depends on parts, it depends on roads, it depends on mechanics, it depends on insurance, it depends on a functioning payments and import system. Remove enough of those, and the car stops being transportation and becomes sculpture. In Venezuela, this became painfully obvious. Newer cars bought when things still seemed normal became almost impossible to maintain. Fuel distribution was broken even in a country floating on oil. Spare parts vanished because imports became impossible. Tires cost absurd sums. Insurance became meaningless when the institutions behind it could not honor the real value of claims. So people sat with relatively modern vehicles that still looked like assets to an outsider and were useless to the people who owned them. That is the horror of collapse. It does not always take things away dramatically. It leaves them there and drains the system around them until they no longer function. Cuba, after the Soviet collapse, gives you another version of the same lesson. Cars that depended on vanished supply chains became yard ornaments. Owners did not lose them by theft. They lost them by disconnection. The ecosystem required to keep them alive disappeared. The people who suffer most in that environment are not the ones who bought old cars cheaply with cash. The people who suffer most are the respectable borrowers, still making payments on a machine they cannot properly fuel, insure, or repair. The debt remains, the utility vanishes. That gap is where financial ruin grows. Maria's Renault did not stop being a car. It stopped being the kind of asset it had been in her imagination. It went from mobility to burden. Fuel cost more. Maintenance became harder. The note still existed. The value she thought she had paid for evaporated because the surrounding system no longer supported the object's intended use. That is the deeper lesson. Middle. Class purchases are usually not merely objects. They are assumptions about the continuity of systems. When the system fails, the object may remain while the usefulness disappears. The third purchase collapse renders useless is long-term financial products sold as prudence itself. Life insurance, annuities, pensions, retirement accounts. The entire family of products built on one promise. Give us money now. Sacrifice consumption today. Trust the future, and the system will pay you back later. Nothing in modern life feels more responsible than this category. That is why its failure is so cruel. These are the purchases made by the obedient savers, the disciplined ones, the people who delayed gratification because they believed the contract between citizen and system was real. The problem is that these products are not wealth itself. They are promises about future wealth, and a promise about future money is only as good as the currency, institution, legal system, and political reality standing behind it. That is what collapses destroy. In Weimar Germany, insurance policies and pensions did not vanish in a legal sense. The contracts remained. The institutions often paid. But what they paid in was a currency whose meaning had been annihilated. So the saver was made whole on paper and destroyed in reality. That is one of the great hidden crimes of currency collapse. It allows the system to pretend it honored the promise while draining the promise of substance. In Argentina, pensions were folded into structures the state could manipulate. In Lebanon, depositors with dollar accounts discovered that dollars inside a trapped financial system are not the same thing as dollars freely accessible in the real world. In every case, the saver learns the same lesson. Long-term financial products are not independent stores of wealth. They are conditional claims on a future system remaining coherent enough to honor them in real terms. That is a very different thing. When you buy life insurance, you are not buying certainty. You are buying exposure to the solvency of the insurer, the stability of the currency, the continuity of regulation, and the government's willingness not to alter the terms of the environment in a crisis. When you contribute to a pension, you are not simply saving. You are betting on the state's or institution's ability and willingness to deliver purchasing power later, not merely nominal units. That distinction matters more than almost anyone wants to admit. Maria's life insurance policy worked. That is what makes the story so evil. It paid out what it promised on paper, and on paper the system could call itself honorable. In reality, the payout bought almost nothing. The promise had been fulfilled in language and destroyed in substance. That is how collapse works. It turns prudence into exposure. The fourth purchase is the university degree treated as a guaranteed economic ladder. Now let me be careful. Knowledge is never useless. A disciplined mind is never useless. The ability to think, analyze, explain, build, negotiate, and adapt matters in every environment. But a degree is not pure knowledge. A degree is a credential designed to signal value inside a specific labor market. And a labor market is part of a system. If that system breaks, the degree can suddenly stop mapping onto the life it was supposed to unlock. In the Soviet collapse, millions of educated people found that the structures their credentials were built for had disappeared. Engineers drove taxis. Scientists sold goods in street markets. Professors did administrative scraps. Their knowledge had not vanished. The market that once rewarded the credential had. That is the distinction. In Greece and Spain, after their crises, a whole generation learned the same lesson in a milder but still brutal form. Families had sacrificed for education, because education was sold as a near, sacred hedge against uncertainty. Then the economy broke badly enough that the jobs disappeared or the wage premium collapsed. The degree remained framed and impressive, while the labor market it depended on stopped offering the life attached to the credential. This is why I say a degree is a bet. It is a bet that the industries existing when you enroll will still need your skill when you graduate. It is a bet that the debt you take on to finance the degree will be serviceable from the income the degree brings. It is a bet that automation, migration, regulation, recession, and structural change will not destroy the job ladder under your feet. Most of the time, across normal cycles, that bet can still make sense. But collapse is not a normal cycle. Collapse breaks the relation between credential and compensation. It changes the lock while you are still holding the key. Maria's degree never disappeared from the wall. That is what makes it such a brutal symbol. It continued to say educated, qualified, responsible, but the economy she had bought it for was gone. She could still work, but not in the way or at the level she had once assumed. The credential survived. The promise attached to it did not. The fifth purchase is the broad category of consumer lifestyle goods purchased on credit. This may be the most revealing of all, because it touches the most ordinary parts of life. The electronics, the furniture, the renovation, the wardrobe, the appliances. The home entertainment system, the small luxuries that tell a middle-class household the story that things are going well. In stable times, these objects feel like evidence of progress. You are building a life. You are furnishing a future. You are improving comfort. You are participating in society as a successful adult. In collapse, they reveal themselves for what they were: consumed liquidity. That is the harsh phrase. Not because there is anything morally wrong with a sofa or a television, because they convert flexibility into fixed, deteriorating objects in Zimbabwe, in Lebanon, in Argentina, in countless smaller breakdowns. Households discovered that goods purchased when money still functioned do not become a hedge merely because they are physical. Goods break, they wear out, they require parts, they have no deep resale market when everyone is trying to sell and almost no one has cash. They tie you to a place, they remind you of money spent that cannot be recovered. And if they were bought on credit, the insult becomes even greater. The object is sitting there, losing practical value in a broken economy, while the debt used to buy it still arrives with mechanical indifference. This is one of the deepest misunderstandings of consumer economies. People learn to interpret consumption as stability. If I can still buy, things must still be fine, but in a collapse, consumption done on credit becomes one of the purest ways to sacrifice future resilience for present comfort. The home theater does not feed you. The designer dining table does not help you move. The renovated bathroom does not produce income. The lifestyle goods that once gave social proof become economic ballast. Maria stood in a room full of perfectly respectable possessions and discovered they had become weight. That is what people mean when they say collapse is quiet. The apartment is still full. The life looks intact to an outsider, but the functional economic meaning of the things inside it has died. Now step back. What do these 5 purchases have in common? Real estate bought at the wrong time. A new car on credit, long-term financial promises, a degree treated as a guaranteed ladder. Lifestyle goods bought on installments. These are not random objects. They are the pillars of middle-class identity. They are what modern societies tell people to want: buy a house, get a car, save in the proper products, get the degree, furnish the life. Every one of these purchases is marketed as responsibility. Every one is sold as proof that you are doing adulthood correctly. And in collapse after collapse, these are precisely the categories that fail first and hardest. That is not a coincidence. It is structural. The middle class is the class most fully integrated into the formal system. Its assets, liabilities, aspirations, and obligations all run through institutional channels: mortgages, payrolls, retirement systems, universities, lenders, insurers, utilities, taxes, regulated payments, bank accounts. That integration feels like belonging during good times. In bad times, it becomes concentrated exposure. The rich are less exposed because they tend to own things outside a single national system and outside a single currency. The poor are less exposed because they never had much system, dependent capital to lose. The middle class gets cut with surgical precision because it placed its faith exactly where the system told it to. That is the deepest cruelty of all. These are not usually reckless purchases. They are disciplined purchases made by people trying to do the right thing inside the world they were given. The problem is not that they were irrational. The problem is that each purchase was a hidden bet on systemic stability. When you buy a home with a long mortgage, you are betting on stable income, stable taxes, a functioning property market, and a currency that will preserve meaning. When you finance a new car, you are betting on fuel access, part supply, stable income, and the durability of the credit system. When you buy insurance or fund a pension, you are betting on institutional solvency, regulatory continuity, and the future value of the currency. When you borrow for a degree, you are betting on labor, market continuity, and a stable premium for your credential. When you fill your house with financed lifestyle goods, you are betting that the future will remain benign enough that converting liquidity into objects is harmless. Those are all bets. That is the sentence people need tattooed on the inside of their forehead. Those are all bets. They stop looking like bets only because the system functions long enough for people to confuse habit with certainty. Then the system breaks and the bets are called, I want to be clear about something else. This is not me saying nobody should ever buy a house, a car, an education, or insurance. That would be childish. In a functioning economy, many of these decisions are reasonable, sometimes even excellent. What I am saying is far more important than a slogan. Understand what you are actually buying. Understand the assumptions embedded in the purchase. Understand that systemic stability is never guaranteed, only assumed. And understand that stacking too many of these bets on top of each other creates one giant concentration you may not see until it is far too late. If I could reduce what the survivors of past collapses understood, it would not be a shopping list of good assets. It would be a handful of principles. They kept some liquidity outside the most fragile intermediaries. They avoided total concentration in one currency, one asset class, one payment rail. One country, they preserved optionality. That word matters more than almost anything else. Optionality means the ability to move, change, adapt, pay, survive, and choose. When the rules shift, they understood the difference between consumption and resilience. And most important of all, they understood that governments change rules in crises. That is not paranoia. It is history. Withdrawals can be limited, funds can be nationalized, taxes can be raised, exchange rates can be reset, contracts can be honored in language and destroyed in substance. That is what the formal system never wants to tell you, because the formal system sells calm. It cannot sell products efficiently if it also tells the customer. By the way, if the architecture around all of this breaks, the logic of what you are buying may collapse with it, so it does not tell you. History tells you instead. Maria eventually learned that every purchase she had been told was stable was really a stack of promises sitting on top of a system that was less stable than she had ever imagined. Her apartment still existed, her car still existed, her degree still existed, her insurance policy still existed. The things remained. What vanished was their meaning inside the old economic order. That is what collapse does. It does not always take your possessions. It takes the world in which those possessions meant what you thought they meant. And once you understand that, you stop asking the childish question, what should I buy in a collapse? The better question is, what am I buying now that only works if the system never changes the rules? That is the question history keeps begging people to ask before the answer becomes personal. Most will not ask it. They will keep following the script because the script feels respectable and because respecting the script is easier than examining the assumptions under it. Then one day the assumptions fail and they will say no one could have seen it. That is never true. The pattern is always there. The only mystery is whether you will recognize it before you are standing in a room full of useful-looking, economically dead purchases, wondering how so much obedience turned into so much fragility.